And welcome to Inside India. I'm Christine Tan, sitting in for Sri Jegarajah. Here are your headlines. The Indian markets capping off the first half of the year with near 10% gains and the Nifty holding on to that 25,000 level. Can it make a run for 26,000 in the second half? We'll discuss. But concerns on the economic front, latest industrial output growing at its slowest in 9 months. Indian officials have said to have extended their visit in Washington to iron out differences over a trade deal. Well, let's take a look at Asian markets and see how it is stacking up. A little bit of a mixed picture, as you can see there. The Nikkei 225 pulling back some gains it made yesterday, down 1%. A lot of wait and see. A lot of people are waiting for that spending bill, that landmark U.S. Tax and spending bill, and how that's going to be pushed through Congress. Trade is also top and center in front of investors' minds, and that's weighing on sentiment across the region. As you can see, investors are really holding out for some deals and how that will impact market flows and news flow. Well, the Indian market's coming online in about 45 minutes, and here's what the GIFT Nifty futures are indicating. Looks like it's going to be a positive start to a Tuesday session. Right now, the Nifty 50 is sitting at 25,517, and dollar rupee sitting at 85.67. While India is still negotiating a trade agreement with the U.S., the Indian delegation reportedly extended its stay in Washington to iron out the details of the deal and possibly reach an agreement. And the White House overnight reiterating that a decision on the deal will come soon.
I actually just spoke to our Secretary of Commerce about it. He was in the Oval Office with the President. They are finalizing these agreements, and you'll hear from the President and his team, his trade team, very soon when it comes to India.
Well, this comes after reports of roadblocks in the talks and disagreements between the two countries. The point of contention for India remains its agri, steel and auto component sector. Meanwhile, the Reserve Bank of India, RBI, releasing its financial stability report. Governor Sanjay Malhotra saying the country's financial system is improving, with low bad loans, robust profitability and strong capital buffers. The RBI also highlighted the resilience of domestic demand in a country where many have been flagging a slowdown when it comes to urban areas. Despite the positives, the central bank flagged that growth remains below aspirations. The RBI expects India's GDP to grow at 6.5% for the fiscal year 2026. Governor Malhotra cautioned that spillovers from external challenges and weather-related events could impact growth. Now, the report also noted external macro risks, including trade and geopolitical uncertainties that are impacting the bond markets, high public debt levels, excessive risk-taking in the non-banking financial sector, and lofty valuations that could amplify shocks. The spillover effects are already reflecting in India's factory activity. Industrial production dropping to 9-month lows in May, growing by just 1.2%. A Reuters poll was expecting the number to come in at 2.4%. That would have been the slowest pace of expansion in 9 months. We had mining, electricity, consumer-facing sectors all remaining under pressure. Let's talk more about this weakness. Sanjay Mathur is Chief Economist, Southeast Asia and India at ANZ. Sanjay, good to have you again. Long time no see. When we look at industrial output, 9-month lows, what does this suggest to you about the kind of structural problems we're seeing in the country, or how do we read this number?
Yes, I think the overwhelming issue here is that domestic demand is weak. Exports are weak. We've seen Indian exports with or without a trade deal, they've been sort of stagnating for some time now. So those are definitely there. At the same time, what seems to be happening behind the scenes, or sort of, in terms of demand, is that we haven't really seen urban incomes grow. There's some sort of revival in rural incomes, but we should remember that urban demand is literally 3 times that of rural demand. So you do need urban incomes to pick up. There is definitely a problem of unemployment. So these are the structural underpinnings, and you might want to add to that that there has also been a fairly large increase in imports from China. And India is not the only one that's dealing with it, but all these things are impeding industrial output. Now, having said that, I think it will also be fair to say that some of the newer industries are not being adequately captured. For example, the jump we've seen in, say, iPhone production in India, are we really seeing it in the manufacturing data? The answer is probably not. And that's something that, we do need some sort of a revamping of this index.
Okay, so you mentioned weakness in urban demand. We had that RBI massive 50 basis points rate cut and, of course, tax relief incentives. Could this help spur a recovery in urban domestic demand?
Our view was that these measures would help, but pretty much at the margin. And the reason why I say it is that household indebtedness has risen quite a bit. Second, savings rates have come down post-pandemic. So unless households really rebuild these savings, I don't think they'll be comfortable at really opening their wallets at this point in time.
We are looking at an urban demand, a rural demand revival as well. How much could it help offset the weakness we're seeing in the urban sectors?
It will help, but I don't think it can offset it. And the reason being that urban demand is so much bigger than rural demand that you need urban demand to grow many times to equate to urban demand, and that's unlikely to happen.
When we look at the RBI front-loading, that massive rate cut, where do you see room for monetary policy in the second half of the year? What would that look like?
Yes, so we think that we still have room for another rate cut, even though the RBI changed its stance to neutral. But the reason why we are saying that is it's not so much the 6.5% GDP growth, but rather it is what is driving this. So we had a big contribution from things like net trade, etc. But if you look at domestic demand, that's really been growing at 4%. A strong Indian economy generally meant that domestic demand was growing higher than headline GDP, and net exports were a drag on growth. But that dynamic seems to have completely changed now.
So that 6.5% annual GDP target, is that achievable?
We're going for 6.1. But even if we get to 6.5, I would focus more on what is driving that 6.5.
What will be driving that 6.5?
So that's really the thing, that you're seeing a better and better contribution from net exports. We also saw that the current account swung into a surplus. But what I want to see is consumption pick up. I want to see corporate investment pick up. And that we are not seeing.
So does that mean that more fiscal stimulus needs to be done? And it's a bit of a challenge because we know the government is trying to rein in its fiscal deficit at the same time.
Yes, I think that we do need more fiscal spending, but it now needs to be more calibrated now that the government has been quite successful in consolidating its public finances. One of the ideas that was floated around a few years ago was to come up with some sort of a universal income that would encompass both rural and urban areas. There is something in the rural sector already. But if we could expand that, I think that would sort of provide a floor to consumption going forward.
We had the RBI report really pressing on the banks to pass down the rate cuts. Can we expect borrowing and bank lending to pick up in the second half of the year, or is there a lot of caution about taking on more debt?
I think that there will be an increased passage of or transmission of the policy rate cuts we've seen. I think the bigger question is, like, when you have weak confidence, does that mean that the consumer with weak confidence is going to really go out and take advantage of lower interest rates? That's a question mark for us. I think that there would be some impact, but again, it's important not to exaggerate that impact. This is not a normal business cycle. If there's a slowdown in demand, there's a loss of confidence, and you've got to make up with it, and you can't make up for it by lower interest rates alone.
And still on India, I mean, that trade deal with the US is also something that a lot of markets are watching. Right now, negotiations, there are signs that, a deal could be hammered soon, but behind the scenes, do you think there's a stalemate? Because agricultural access is something that India has been fighting against to concede with the US. Do you think they can hold on that line, how they can toe that line, and what would a deal with the US look like?
So I think that that's going to be the stickiest point. I think as far as manufactured exports are concerned from the US, we'll open the doors to it with lower tariff rates, etc. Agriculture is a sticky point. And even though agriculture is now 15% of GDP. The point is it provides a livelihood for a much larger share of the population. So that is one area that's going to remain stuck. The other thing is, if you were to sort of look at it from the Indian side, if you were to sort of, or the Trump administration finally moves to a world of universal tariffs, the 10% tariff rate, but now you have a trade deal with India that says, tariffs would be higher than that. That really puts India in a difficult position, because now you're going to have to renegotiate yourself to the universal tariff. So these are impediments right now.
If we don't get that trade deal, do you see a revision to India's GDP growth?
I would say unlikely. And the reason why I say it is, actually trade is a fairly small part of India's growth. So I wouldn't be too worried about it at this point in time in terms of impacting the headline GDP numbers. But yes, it does have an impact on corporate sentiment for sure, on investor sentiment for sure.
What would that look like in the second half of the year? Unless we get some certainty, are we going to get a lot of indecision, a lot of holding back on capital spending? And how is that likely to impact certain pockets of the Indian economy?
It will impact some pockets, but a small amount. Yes, we would like to see more certainty. And one of the things we've been tracking is that corporate investment in India does get impacted by global economic policy uncertainty. I mean, there's a fairly tight correlation between the two.
When it comes to policy taken by the Modi government to really boost domestic demand, what would you like to see happen to support economic growth? I mean, you mentioned pockets of growth, but income disparity, wage increases, disparity, and employment, are these areas being addressed by the Modi government, and how successful have they been?
I think that they are being addressed, but we have to remember India is a large country. So the measures they don't filter down quickly, and second, I think a lot more needs to be done. And this is really something where I feel quite strongly about, is that if we were to come up with some sort of a universal basic income sort of program, I think that would really be supportive. It would certainly be supportive of the consumer sector for sure. And eventually that would also become a driver of investment in these industries, labor-intensive industries. I think that could probably be a sort of good strategy. I guess the question really is that we also need to balance it with fiscal discipline that's been going on for the last few years. And that also means that we have to rejig expenditures more from sort of capital spending towards revenue spending. And that's always a difficult political decision.
And how do you see Modi taking that direction? Do you see any changes, any drastic changes? Do you see any surprises?
Christine, it's way too early to sort of say that right now, because remember, even if we do come up with such a program, it's going to take a couple of years to really get on with it. I mean, it's a big country. You need to identify the beneficiaries, etc. So I wouldn't hold my breath for that.
Okay, let's end on a positive note, because there must be pockets of growth within India as well. EVs, IT, pharmaceuticals, right? These are sectors that are growing. Could they provide some support to the Indian economy, and to what extent?
Absolutely, and these sectors are providing. And to be sure that, outside of IT, the other sectors are not particularly labor intensive. But one area that's really worth highlighting is global capability centers. So I remember, a decade ago when you were discussing this topic with you.
A decade.
Literally a decade now. I think it would be fair to say we would talk of software services, we would talk of call centers. But this is such a dramatic reversal to create a capability center. It's no longer about cost arbitrage. It's about what these capability centers, what they're capable of doing. And that's a lot. And that field is expansion.
Data centers now, cloud expansion.
Absolutely.
Yes.
Absolutely.
It's evolved.
Just back office. I mean, and even things like accounting services, legal services. You go to Bangalore, you go to Hyderabad. These sectors are growing at such a torrid pace.
Is there an AI story happening in India?
It is happening. I am not an expert on this. You can see pockets of it. But I would just say just a general offshoring of corporate functions, whether you're a consulting firm, manufacturing firm. And when I say functions, I also mean R&D. And that's a big change.
Sanjay, what can I say? 10 years. We were only, 26 then?
Probably. I was 16 though.
Thank you so much for your time. Great
Thank you.
talking to you today. Good to see you here at SGX. And that was Sanjay Mathur from ANZ talking to us about the India economy. Well, in the U.S., we're continuing to track voting on President Trump's so-called Big Beautiful Bill. Senators going through another marathon session of amendment votes as they try to get the bill over the line and onto Trump's desk. NBC's Ryan Nobles has more.
Tonight, Senate Republicans dashing to deliver President Trump's Big Beautiful Bill to his desk by July 4th.
This is the most momentous legislation of my lifetime. This is going to be the largest tax cut for Americans in our history.
But Democrats looking to delay it with a so-called vote-a-rama on amendments likely to be voted down.
How do you feel about the process so far?
Well, now there's going to be a lot of amendments, and ultimately I'm going to vote no.
And now new criticism from a familiar foe. Elon Musk, who previously apologized for unleashing personal insults against President Trump, tonight slamming the Porky Pig Party for insane spending and threatening anyone will lose their primary next year if they support it. The White House says Musk is opposing the bill because it takes away electric vehicle tax credits that help his company Tesla.
I haven't spoken to him much, but I think Elon is a wonderful guy, and electric vehicle mandate, the EV mandate, is a tough thing for him.
The bill delivers on many of President Trump's campaign promises, including extending the Trump tax cuts and giving billions of dollars for border security, as well as eliminating tax on tips and overtime. But it also makes changes to Medicaid, including imposing work requirements to get benefits. North Carolina Republican Tom Tillis opposing it.
What do I tell 663,000 people in 2 years or 3 years when President Trump breaks his promise by pushing them off of Medicaid?
President Trump said he would support a primary challenge for Tillis, who then abruptly announced he would not run for re-election. The president calling that great news.
Do you think there's going to be a lot of changes to the bill over the course of this vote-a-rama?
I don't. I think that there are some improvements and some clarifications that will need to be made. It's the best product that you can produce with the votes you can get.
Most Republicans believe that once Trump makes it clear he wants it done, the votes will come fast.
Is President Trump able to come in and close the deal?
Yeah, absolutely. I mean, he's the closer.
Well, coming up next, India is not the only country trying to work a trade deal with the U.S. as soon as possible. Japan is also in the fray. Could an agreement come soon? We'll discuss after the break. Welcome back. You're watching Inside India. We've just heard the Indian Foreign Minister saying India and the US are in deep negotiations and trying to find a meeting ground in the trade talks. But tough luck with Japan. Lynn, is the 7th round of talks, I'm not counting, and still no deal. So what's going on?
Look, I think, Christine, we've heard the US president and White House officials talking about some of the issues, and they're wide-ranging, but ultimately it comes down to one figure, which is the trade imbalance between the two countries. Last year, it sat at $68.5 billion. And a day ago, we heard the US president talking about the fact that he believes that the Japanese are not buying enough US vehicles. And now today, earlier today, it's about the fact that he believes that Japan is not buying enough US rice as well. The implication of that, and we do have the post that he put up on Truth Social as well, is that basically he says if we cannot reach some sort of a deal, then we will just end these negotiations and provide Japan with a letter of notice setting out what the terms of trade will be beyond July the 9th. The expectation is the resumption of that so-called reciprocal tariff rate, and for Japan it's at 24%. Of course, that could be extended as well, and that is subject to the US president's discretion. These issues around autos and rice, they have come up time and time again. They came up during Trump's first administration as well, when he was negotiating with the late Shinzo Abe. And on the point of rice, it is a politically sensitive topic. Certainly, Japan has been in the throes of a rice shortage, a pretty historic one, although that has improved. But certainly, with an election coming up, and we heard from the top cabinet official as well, he basically said we won't sacrifice the agriculture sector to try and reach a deal, that we will continue to bargain in the interests of our own national interests in Japan.
So we could get an outcome where no trade deal is reached. But in the meantime, we've also got a survey as well about sentiment. Tankan survey out today, a key gauge of business sentiment among companies. What's the pulse check on that?
Right. So against what the broad economist expectations were for the second quarter, which was, of course, the period where we heard the so-called Liberation Day tariffs as well as the auto tariffs coming into effect. In fact, when we look at the sentiment from the manufacturers, that slightly improved. So that is despite the fact that there is no trade deal, and also there is, of course, still lots of concerns around tariff risks. Even though exports are now falling, what we saw in terms of the business capex picture for manufacturers, particularly the big manufacturers, is that it was revised much higher for FY25. So in the first quarter, it was at around 3.1%. It's been revised up to 11.5%. But keep in mind again that there are seasonal reasons for this. The folks over at Goldman Sachs make it very clear that Japanese corporates are traditionally very conservative at the beginning of the year, and they will often increase their capex spending expectations at around the second quarter of the year as well. It's also worth noting what we saw in terms of the non-manufacturers index, which is effectively the services sector. And we did see a bit of a fall on that front, keeping in mind that there are concerns around the domestic demand and consumption story in Japan as well. And on the whole, when we look at the outlook side of things, regardless of the size of the business, we did see that sentiment is expected to fall in the next 3 months. And that is certainly the view coming through from many analysts, like the folks over at Credit Agricole, as well as Moody's Analytics, is that if we do not get some sort of even a partial trade agreement coming up because of concerns around the domestic economy and then also these duties, that it's unlikely we're going to see these sorts of numbers coming down the track this year.
Okay,
Christine.
So we're going to brace ourselves for more weakness. Lynn, thank you so much for that. Lynn talking to us about the Japanese economy. Meanwhile, we have Trump continuing to put pressure on the Federal Reserve, sending Fed Chair Jerome Powell a handwritten note comparing interest rates around the world and telling him he was, quote, as usual, too late. U.S. interest rates are currently in the 4.25 to 4.5% range, but Trump wants them at 1%. Trump can't fire Powell, but the administration is making moves to find a replacement in line with its policy objectives. Trump's comments have raised concerns around the Fed's independence and has led to weakness in the dollar. Well, over in Europe, the ECB's annual central banking forum is underway in Sintra, Portugal. CNBC's An Advisement spoke to the governor on the National Bank of Belgium, Pierre Wunz. Here's what he had to say on the ECB's rate trajectory and if the central bank's done with its cuts.
I think there is a broad consensus that we are very close to target now, and so that the job is mostly done. Now, if I look at the balance of risk, I think now the risk is maybe a bit more tilted to the downside on inflation and growth. We've had 2 years of relatively slow growth in Europe. We're waiting for this recovery, but of course with the uncertainty it might be again delayed a little bit, although the economy is resilient. So if anything, I think if we would have to move more, I would probably be on the downside, a further cut. I'm not pleading for one, but I think if there is any discussion, it's more on that direction.
And we'll have more from CNBC's coverage of the ECB forum in Sintra, where Fed Chair Powell will also make an appearance. He will be on a panel that will also include the heads of the ECB, the Bank of England, the Bank of Korea, and the Bank of Japan. We will be speaking to some key global policymakers on the sidelines of the event. So stay tuned for our coverage later this afternoon. Coming up next on the show, we'll get a pulse check on Indian markets in the first half of the year and talk outlook for the second half with Arun Leslie John, Chief Market Analyst at Century Financial Inside India. Taking a quick break. We're back in 2. And welcome back. You're watching Inside India, some of the stories we're keeping tabs on this morning. China and India talking about their long-standing border disputes. This comes after the Indian Defence Minister sought a de-escalation of the tensions at the border during his visit to China. The Chinese Foreign Minister responding, saying that the issue is complicated and will take time to resolve. But Beijing says it is ready to open communication channels.
We are willing to maintain communication with India on issues such as demarcation negotiation and border management, to jointly safeguard peace and stability in the border region and to boost cross-border exchanges and cooperation between the two countries.
The Dalai Lama of Tibet has begun a three-day gathering in India's Dhammaran. He's hosting Buddhist figures ahead of his birthday. The world, especially China, will be watching to see if he addresses the issue of his succession. The Dalai Lama fled China back in 1959 and has said that whoever follows him will be born outside of the country. Beijing says it has the right to approve the successor, according to rituals dating back to 1793. At least 30 people have died after a blast in a pharma factory in Hyderabad. Local media said a reactor explosion at a chemical unit of Sigachi Industries caused the fire. India's Prime Minister Modi has announced recompense to the next of kin of the deceased and those who have been injured. And we are counting down to the market open in India, and this is how it is shaping up as far as the futures are concerned. Pretty much flat at this point in time. A lot of wait and see, like the rest of Asia, about a huge spending bill and tax legislation in the U.S. The Nifty hovering at 25,517. It's managed to hold on to the 25,000 level in the first half of the year. Pretty resilient, as I talked about, in the first half. Nifty managing to close almost 8% in Q1 despite volatility due to geopolitical events and Trump's tariff threats. But now the question is if the gains will be sustainable going into the second half. Saurabh Mukherjee of Marcellus Investment Managers was on Squawk Box this morning, and he highlighted why July could be a tricky month for the Indian markets as the U.S. tariff deadline looms.
And I think if 8th to 9th July, whenever that trade deal is announced, the free trade agreement is announced, if that doesn't work out favorably, I think that itself will be a pretty powerful trigger for the Indian market to correct. As I said, valuations are elevated, earnings growth is slowing down, and we need a positive FTA with America for the market to hold up. If that doesn't work out, I think both on the rupee and on the stock at the stock market level, we could see a pullback.
Let's talk more about the Indian markets and its movers. Arun Leslie John is Chief Market Analyst at Century Financial and talks to us on the line from India. Arun, good to have you with us. You heard what Saurabh was talking about. That trade deal with the U.S. is going to be a big trigger, a catalyst for the markets to move lower. You agree?
First of all, good morning and thank you for having me on the show. Yes, the trade deal with the United States will be a big trigger for the markets going forward. If the India and United States, they're able to conclude a trade deal with minimal issues, the markets will be taking that in a big positive way, and hopefully there could be another leg up or another set of a rally which could take the Nifty higher to 26,000 levels.
Okay.
That can obviously be a big trigger.
A big trigger. Our markets, do you think, are they ready for the reciprocal 26% tax if it arrives? Have they priced that into the markets?
Not really. At this point of time, the markets have not priced in the reciprocal tariffs. But having said that, it is worth noting that the impact of reciprocal tariffs on India when compared to other major global economies might be minimal, for the simple reason that India is not that much integrated with the global supply chains, maybe, for example, when compared to the more industrial economies of Southeast Asia or even China. So from that aspect, the impact would be minimal. India, as everyone knows, is more of a service sector economy rather than a manufacturing economy. Its merchandise trade, the global market share, the global trade share is still limited when compared to its service sector. So, the reciprocal tariff is still not priced in, but the impact might be not that huge as the fear is.
When you look at the resilience of Indian equities, managing to rise 7.9%, almost 8% in the first half of the year, holding on to that key 25,000 level, do you see the Nifty hitting the 26,000 level in the second half? Is there momentum for that to happen?
There is momentum for that to happen. There is an uptick in the economic activity. The manufacturing PMIs as well as the service sector PMIs, they are showing improvement there. The rural demand is gradually beginning to pick up. So the fundamentals are improving at this point of time. So hopefully that should help the Nifty hit the 26K levels. A trade deal with the United States and other major economies will be the icing on the cake.
Icing on the cake, certainly. RBI giving that bazooka of a rate cut, the bigger than expected 50 basis points rate cut, really giving the markets something to lean on to move higher. Could we see another rate cut from the RBI in the second half that could give the market some legs?
Further rate cuts from RBI might be limited, but I expect the RBI to be hold for the time being, even though the inflation has declined, giving the RBI some space to cut the rates. But RBI is likely to play it safe for now. So support, maybe there might be another 25 basis point rate cut, but that could be, it seems limited as of now. So support from the RBI, but RBI has released a huge amount of liquidity to the market. So the liquidity shortage in the economy is not there, which was previously. And RBI seems very supportive from a growth perspective. So support from the RBI is there, but further rate cuts might be limited.
When you look at the growth story in India, you can't deny the fact that there is one there. But the perception among global investors is that when you look at the markets, it is richly valued. Where do valuations stand in the Indian equity market? And can India continue to command that kind of premium?
I would like to think so. The valuation premium for India comes from the relatively higher GDP growth among the when compared to other major economies. So this year also, this financial year, the Indian economy, according to RBI, is likely to hit the 6.5% GDP growth rate. Now, if India is able to consistently hit that level of growth rate, some amount of valuation premium might be justified due to the scarcity of growth in other parts of the world. The economy is still $4 trillion plus economy growing at 6.5% per annum. It's a good one. So India, should be able to attract global capital. Plus, there's a huge amount of domestic capital also, which is getting rerouted from the banking system to the stock market equities. That equity culture is still catching up. So there is a strong probability that the valuation premium in India will exist and can be sustained.
Arun, before we drill down to sectors, where does India stand in terms of global emerging market strategies? The Buy India, Sell China strategy, the narrative, is it still intact?
Not really. At this point of time, the Chinese equities also are gaining traction. There was a period of time when Indian equities enjoyed a lot of flows at the expense of China, but not anymore. The Chinese equities also seem to be on a strong wicket right now. Like India, if China also is able to conclude a trade deal with United States, it should be able to attract a lot of inflows. So, we are positive on China, but we don't think that India will be attracting flows at the expense of China. Because especially the Chinese equity picture also is improving a lot.
Let's talk about sectors, and this is what Saurabh Mukherjee from Marcellus Investments Managers had to say about India's defense sector. Take a listen.
It's a crowded trade. It's at stretched valuations. Historically, it's been very difficult for the government of India to expedite big defense spending. There's a whole bunch of regulatory challenges in pushing through defense spending, and the valuations of these stocks are eye-watering. I think India will increase its defense spend. Recent hostilities with our neighbors up north are going to be a trigger for pushing up defense spend, but I suspect a lot of that money will go on arms purchased from abroad.
Arun, do you agree with Saurabh? You have a buy on the defense sector in India.
I agree with him that that this is a crowded trade, but I mean, if you look at the defense sector spending as a percentage of India's GDP, it has actually declined to about 1.6% of the GDP. So there is a lot of scope for the defense sector spending to expand in the coming year. I mean, the rising tensions, the recent sporting tensions with India's neighbor Pakistan means that India might be forced to increase the defense spending as a percentage of its GDP. So, and plus there is an added emphasis on local production of defense equipment. So the defense sector firms in India, they have strong tailwinds behind them. Additionally, we should also be taking a note of the fact that Europe also is increasing its defense spending due to the tensions inside Europe, or to balance Russia's economy, Russia's military might. I mean, by some estimates, Europe might be spending maybe upwards of 500 billion in the next 10 years. So a part of that defense orders also is likely to come to Indian firms also. I mean, South Korea also could be another major beneficiary. I mean, partly due to the strategic concerns. So Indian defense firms, they are on a good ticket right now. We will continue to have a buy on dip approach to these firms.
And we've seen defense stocks trading right now, all moving to the upside, as you can see there, all in positive territory. Arun, can I get your take on the banking sector? We had the RBI report that bank loans, the bank's bank loan ratio at multi-year lows. It's a good sign. It's supportive of the banking sector. You like the banks, and which of the banks do you like?
So I would prefer to go with the large cap banks in itself. I don't want to specify any names here, but I mean, for people who are looking for a sectoral play, banking ETFs in India can be a good choice. Now, again, why we remain bullish on banking? Again, the non-performing low assets, the banking balance sheets have been cleaned up. The NPAs have come to near a decade lows. So a lot of hard work that had to be done is already done. The sector seems poised to has the potential to give good capital returns for investors going forward.
The auto sector also is interesting. You like the auto sector particularly. How much of that is because of the EV story that's happening in India? At the same time, there are all these concerns about rare earths disrupting production, also competition coming from external EV players as well. Does this sector, in your mind, continue to remain challenged, or do you see bright spots in the auto sector?
So the auto sector has done well in the first half of the year, I mean, relatively speaking. So, I mean, again, it's a play on India's domestic economy. It's a play on India's domestic consumer. I mean, a play on the consumption story of India. So right now, India's per capita GDP is something like $2,900. So in the course of next 10 years, we expect it to rise substantially, maybe go above $5,000 level. So when this happens, there is a very good probability that the auto sector will be benefiting significantly. So among them, the electric vehicle theme seems very strong right now due to the continued government support. There are obviously external threats. Threats from imports are there. But given the Indian government's approach, they tend to play it safe. They tend to protect the domestic manufacturers by imposing high import duties. So we would like to believe that the domestic EV story, the domestic EV companies are likely to be insulated from the external threat. But yeah, the auto sector is likely to do well in terms of numbers going forward.
Arun, so much focus on China's AI story. We've been talking about this the whole morning. Is there an AI story going on in India right now that could offer pockets of investment opportunity? And in particular, I want to bring in this explosion in growth we're seeing in data centers and how that could benefit the real estate sector.
Unfortunately, at this point of time, I would say that that's a big shortcoming of the Indian market. There are not much listed players available to play the AI story. When China has companies like Alibaba, Baidu, US has Alphabet, Microsoft, Amazon, or Nvidia on the hardware side. Unfortunately, there are no AI pure stories or pure plays available in India at this point of time. So that is certainly a big shortcoming of the Indian market. The economy or the stock market, even now, tends to be dominated more by the traditional companies with a smattering of some IT consultancy companies. So AI plays are limited.
What about energy? This is something where there's a lot of volatility surrounding crude, but refining margins are improving. Do you like this particular segment?
Yes, exactly. As you know, Reliance Industries is an obvious play on this particular sector from the private sector perspective. Then there are public sector enterprises also. The refining sector, in terms of price, we expect the oil prices to come down in spite of the regional tensions there. We would like to believe that the OPEC's decision to hike its output in the coming months could pressure oil prices, and that should indirectly boost the refining margins. So the refining space should be doing well in India going forward.
Arun, we were talking earlier with our earlier guests that, there could be some sort of fiscal stimulus and support coming in the second half of the year because the RBI has already front-loaded the 50 basis points rate cut, and much of it has now to be left in the court of the government with fiscal stimulus. Is there any sector that could benefit from any sort of fiscal pump priming that, as an investor, you could look into and get into?
Apart from the obvious push to infrastructure, which the government is already doing, we would like to take a look at the FMCG stocks. A part of the fiscal stimulus might be targeted at boosting the income in the rural areas. So FMCG sector, FMCG companies, they are a direct play on this theme. We would like to take a look at them.
All right. FMCG it is. Arun, great to talk to you today. Thank you so much for being with us. Arun Leslie John from Century Financial talking to us about Indian equities and markets for the second half of the year. Well, Indian markets have joined a trading day. Let's take a look at some of the movers in Mumbai after this very short break. We're back in 2. Let's do Indian markets. They're coming online. Nifty 50s trading a little bit flat at this point in time. 25,564. A lot of wait and see about the US-India trade deal. Dollar rupee, dollar a little bit weak right now, and that's pushing up the Indian rupee. The dollar's getting hammered because of what's happening in the US as investors wait for the US fiscal and trade policy, and that's how that's weighing on the greenback. Let's take a look at some of the movers in the Indian markets today. Shares of Apollo Hospitals trading to the upside, up more than 4%. The hospital chains operator spinning off its digital pharmacy business. Apollo plans to separately list that unit within the next 18 to 21 months. For per 100 shares of its Apollo, its existing shareholders will get around 195 shares of the new entity. We're tracking shares of Torrent Pharma as well after the pharma giant inked one of the biggest deals in the sector. Torrent is up just a touch there. The company buying KKR's stake in JB Chemicals. Torrent says the acquisition will be completed in the next 15 to 18 months. The deal that's worth over $3 billion will see Torrent Pharma merging JB Chemicals with its business. And meantime, HCL Tech has inked a multi-year partnership with OpenAI. The two companies will collaborate to scale up Gen AI adoption across global companies. HCL Tech's clients will use AI to transform their businesses. And just in, auto parts maker Hero Motors filing for an IPO. The company that counts BMW and Bugatti as its clients is looking to raise up to $350 million through the issue. The filing comes after the company withdrew its draft papers back in October last year. One final check on Asian markets and see how it is stacking up for a Tuesday. A little bit of a mixed picture, a lot of wait and see about that U.S. legislation when it comes to the tax cut spending bill and the legislation that is going on in Congress right now and what that would mean. So markets are wait and see mode. Nikkei 225 clawing back some gains made yesterday. 4,000 level is where it's holding at, and the Hang Seng also drifting lower 0.8%. The clock is ticking fast towards that July 9th tariff deadline. Southeast Asia's largest economy, Indonesia, planning to ease restrictions on its imports in a bid to open up its economy. And JP Ong joins us now with all the details. JP. We seem to be having problems hearing JP right now. Let's do a quick check on the markets so we get that sound sorted out. As you can see, a lot of the movers and drivers in the equity markets right now. This is how it's stacking up. The Taiwan weighted index up 1.4%. The Kospi also doing pretty well, up 1.3%. Elsewhere, the SCT index, political drama actually unfolding in Thailand, and that's keeping the market pretty much flat in time. Elsewhere, we are seeing the Hang Seng index down 0.8%, 24,072. But for the first half of the year, the Hang Seng did pretty well compared to its mainland counterparts, up 20%. So we'll see whether in the second half of the year that HCI will be able to carry on that momentum into the second half. Let's get back to JP to see if he's got his sound sorted out. The deadline on largest economies planning to ease restrictions on its import in a bid to open out its economy. JP Ong is standing by with all the details. We don't have him as we speak. But let's take a look at what's happening in the overall currency market and see how that is stacking up. A quick check on the currency markets. Dollar rupee seems to be holding up pretty well. We are looking at rupee strength because of what's happening with the dollar slumping to fresh multi-year lows on worries about that U.S. fiscal and trade policy. So traders say the upside for the rupee could be limited, stating that the recent price action points to persistent dollar buying by importers. So that seems to be driving rupee trade right now. And that's all the time we have today on Inside India. Keep watching CNBC. Access Middle East is coming up next.